Concentration risk. It's something that most investors and traders like you and I don't talk about enough. But with Nvidia overtaking Apple and moving from a $2 to $3 trillion market over the last 24 hours, it's clear that markets are just ramping up to new all-time highs. But what makes this point a little bit different? Well, as it comes back to the data, 90% of the time, something a little bit shocking happens next. So let's investigate that together as we break down the hottest stock in the world right now and why stocks, commodities, and cryptos need to be all followed during this point. Let's get into it. There's a lot to discuss. Well, welcome back, everybody, to The Daily Show. My name's Tom, and as always, we're going through the macro, the data, the lead indicators, and everything we need to be talking about in markets. But it was clearly run by one big show yesterday, and that was semiconductors. And in today's video, we need to talk about it, but we also have been having some amazing trading sessions. So make sure to subscribe and smash that bell icon if you want to find out more about how we figure out where the flows are going right now. Let's discuss the idea of retail money on the sidelines. Now, this is a topic that has been used many times over the last couple of years, but as I'll show you, you might want to think about it a little bit differently after today's video. Now, interestingly, a few major outlets are starting to discuss this again. So what you might notice about money market funds is that they tend to rise into recessions. In fact, this is something that we've seen mostly with every single previous phenomenon, where they've gone up and they've dropped off, leading to huge rallies in the markets after the recession has actually come through. A different way to think about it. So next time you look at these charts, you really kind of want to see money market funds continue to rise if you are a huge bull in the markets. Now, this is where it comes into a little bit of a discussion point because, of course, Goldman Sachs are trying to convince everyone that July is going to be fantastic. And it may well be based on some seasonality factors we'll talk about during this point, but they're claiming a flood of cash from passive equity allocations will pour into the stock market in early July, setting up a continued rally. In fact, they believe it's a wall of money that comes into equity markets quickly, and they also think that it's going to be very strong for the first 2 weeks because, of course, since 1928, the first 15 days of July have been the best 2-week trading period of the year for equities, and they tend to fade after that period of time. So does that mean that this is actually going to work again? Well, let's have a look at the breadth behavior of the markets because, of course, we've had a market that's very strong recently. It's making all-time new highs, but at the same time, breadth has been seriously declining over the last couple of sessions. Is this something we need to be concerned about? Well, you can see here Grant Hawkridge's chart basically showing that market bull breadth behavior is starting to drop, and this is getting a little bit concerning for many people out there. In fact, it's also concerning to see that the Russell 2000 has failed to get anywhere close to the S&P 500. Now, the number of days for the Russell 2000 down by more than 10% from the previous new high has actually entered into a period not seen other than after recessions themselves. Now, you could argue that this is kind of why there's a pseudo recession that probably went through in some ways in the US in 2022, because of course, companies that make no money, which tend to be in the Russell 2000, as we know, like 37% of them is make no money, are still struggling out there. And they're going to have to reborrow, as we've already seen, with cliffs starting in 2025, 2026, and 2027 that look incredibly worrying. So why does all of this become important? Well, it comes back to market concentration. And you can see here that we're starting to get into points that we haven't seen in quite some time. In fact, concentration is now higher from the top 10 than it was back in 2001. And you'll notice here that even in the top 3, concentration is starting to get back into some of the narratives that we saw back in the 1960s. Now, this is something that will be needed to track because you might think, well, concentration equals bad. But in the world of capitalism, it actually is not necessarily very bad. In fact, when we've had very high concentrated markets, they tend to be very bullish. And you'll notice that's kind of where we've been over the last 10 years plus of investing, with the Mag 7 in particular, and anything to do with large tech stocks really becoming such a huge part of the market. They've driven those massive gains. When we don't have huge concentration, it tends to be a weaker period of overall annual returns on the stock market. So all good, all green, right? Well, kind of. And that's why it's so important to look at all of these stats together. We already know that if those big companies are making really good money, it tends to be good. And at the moment, that is how it looks. But when we do get NASDAQ competition the way it is, we still need some breadth. It doesn't mean, oh yes, we want those big stocks just to run away and not bring the others with it. We do need that 52-week high lows continue to actually go bullish. And in this case, what we saw over the last 24 hours were fewer stocks on the exchange of the NASDAQ rising to 52-week highs than falling to 52-week lows. So that shows us a very concentrated market with almost no breadth. Now, although we don't have too many reads on here from Jason Gopfert over on X, if you want to follow him, you can see here that they tend to rise in all of the periods that we've discussed several times before that have similarities with the current markets right now. Of course, the rise of a new technology, AI versus the internet, and in this case, the rise of the everything kind of rally in terms of GameStop and all of these other psycho kind of petitions that are going on right now in the markets. Now, when you get this type of thing, what happens? Well, only 10% of the time was the market bullish over the next month. And you'll notice that it really starts to lead into a bit of a dicey kind of period. Now, I'm not here to say, oh, wow, we should all sell the market and run away. Of course, you want to use price action every single time to make sure that you're seeing these types of signs. But it does put you on a cautious route to make sure that breadth starts to improve if we do continue to climb higher. It also puts us on alert to late cycle investing, which is something we've been discussing quite a few times here on the channel, which basically means that we probably are 1 to 3 years away from something kind of bad happening in the markets. And I mean seriously bad, not just necessarily a little 10% pullback. So how often has the S&P 500 peaked in the year of each month? Well, as it turns out, if you go back to 1950, and I know this is 1980, it turns out it's never actually done it in the month of June. So good sign for the bulls. Yeah, interesting stat for sure. But notice that usually in terms of peaking for the year, most of them end up in, of course, December and sometimes also in January. So it turns out that they're actually the 2 months that usually see the peaks. Either you get a peak at the start, it kind of goes off, or you get a peak where you'd expect it to be, which is December of the year. Some interesting stats here. Most of it's either concentrated near the end or right at the beginning. And that's why we always look at that January stat every single year, which at the moment is pointing towards the normal election year kind of period, which is a little bit of instability coming into the election, then bullish. And then, of course, 2025 will give our synopsis on that probably at the end of the year with an overlay of what we're thinking for the rest of the market. So let's talk about secular bull markets. This is a chart we bring up all the time. And the reason is quite simple. We're talking about 2000 before. We're talking about the 60s, funnily enough. And in both periods, these are the overlays that we've been talking about. A market that is continuing to rally, but not necessarily getting too carried away. And at the same time, it's doing everything that you would usually expect. Now, how long do these tend to last? Well, they last a while. And as you can see here, that kind of points towards another 1 to 2 years minimum of really being able to get through. Now, if you remember, our minimum amount of time that we usually expect a cycle to last in terms of a new bull cycle is around 33 to 35 months. So because of that, and we're about 20-ish months in, you would kind of think, well, we've got a period of time still to go. And that is suggested also when we look at earnings valuations. If you actually looked at the valuation here to the valuation here of the markets, you might actually be surprised to know that the forward PE is actually cheaper than it was over here. So actually the market is a little bit better priced than it was before, although it's still getting into these upper echelons. Now, why is this important to note? Well, this is the way bubbles work. If we're entering into a bubble similar to the dot-com boom, of course, we must go through and outside of these types of Bollingers, or in this case, an earnings ratio. Because if we do that, then we enter into a super bubble, and those are the ones that end up crashing with very negative kind of correlations on the markets. So where are we right now? Well, it looks like we're starting to push those envelopes a little bit too much. We're starting to get up here, but we're not quite in the super danger zone that we saw during the dot-com bubble. So again, be wary of these things, be cautious. But when you look at market cycles, this is usually the way a really good big bull rally starts. We've got things like Magnificent Seven becoming hugely concentrated, tech bubble hugely concentrated. Obviously, we expect a little bit more percentage based on previous times of inflation. So 53 currently, maybe somewhere up to the 70% minimum is what we expect this market to be able to pull out. And all of that kind of leads into continuing to be overall bullish. Now, we showed you a really negative sign that is related to about 5 dot points on the markets. But obviously, if you go through and you think about monthly returns of May, it usually leads into June and the rest of the year being positive. So there's two ways to cut data, and I think it's really important that you consider that. Price action will ultimately be the big deciding factor, and a continuation of degradation underneath the hood using some of the lead indicators that we'll discuss later on today's video. Are we seeing those? Let's just quickly discuss China before we go into the S&P 500 analysis for today. I just want to mention again that things are starting to improve, even though you may not think so. We're starting to see property markets potentially turning. Some of the stimulus that's coming in from the Chinese market is starting to work, and we're at that nice pullback zone that we'll look at later. So pretty interesting stuff going on there, and we've been going over that in quite detail because they have suffered effectively a giant bear recession on their markets. Another reminder, if you haven't already followed us over at X, please do so. We're posting S&P 500 charts all the time at the moment, and they've been pretty accurate in terms of some of the key levels we're discussing over the last week. Why? Well, it's been a pretty good time. Now, it's not always going to be a great time for it, but yeah, it has been pretty good. Let's just quickly go through one unusual dark pool activity. We saw, of course, the other day, a big dark pool on IWM. We saw a big dark pool over the last 24 hours down here, which we discussed. It rallied hard, and it's hit back into that red zone. So if the market is able to push IWM higher than this level here, which sits around 204.5 on IWM, then that would be quite bullish. And we'll look at that just a little bit soon. Now, what about the overall 5-day averages? Which sectors have been hot, which have been not? So you might think, well, semiconductors clearly number one. As it turns out, actually biotech, REITs, healthcare, ITB, which is good to see home construction coming back, and XLP are now up the top. Also, one of our favorites at the moment, solar, doing okay over the last 5 days. Last 24 hours, bit of a difference. Clean energy, solar, really beautiful moves from them. And of course, the rise of Nvidia running through with semiconductors, pushing a 4.87% day. Now, all the things that you would usually expect down the bottom are there. Usually you'd expect things like staples, utilities, healthcare not to be really holding up that well, everything on rally that's got to do with basically high growth companies, and that is where it's at. Nothing changes from my opinion on utilities still being a very decent sector over the next year though, because of course I do think we're in late cycle investing at this stage. Let's now talk about the S&P 500. Now, as you can see here, the advanced decline line is starting to improve. So overall, the broad market is okay, but it hasn't made a new higher high as we make a higher high. So again, it's being led by a couple of companies, and I think we all know some of the ones that are leading it through. When we have a look at the volume footprints in terms of whether the delta was positive or negative, which we'll load in just a moment, then you'll see here as we zoom in that it was actually a negative session. So overall, even though it was coming up, the delta was net negative, and that's a bit of a difference from the last 3 sessions, which suggested that there were strong buyers in, and of course they were. Now, why could this be? Well, I think it's because we hit straight into the call resistance, and obviously some people are probably taking a little bit of profit off their huge runs over the last couple of days. We find ourselves on the call resistance for Thursday, and a clear path at this point you would think towards 5,400. As long as the market keeps ramping, it's in a positive gamma situation, which basically means that every time it pushes through these call resistance levels, it creates hedging that may need to be done in the futures market. And as well as that, if it does pull down, there's an excellent buying opportunity from technical level anyway, where we've got the put support on Friday sitting around 53.25, and of course the most traded zone, previous resistance, a lot of structure reasons to like around here, even down to the 52.80 zone. So really everything in here, you've got to think bulls are going to be sitting there. It's very difficult to be a bear in the market right now. And of course, other than that stat, you have not seen any price action. I think that's very important to state. If you get price action and a stat, yeah, that might be worthwhile considering. But if you're not seeing leads, if you're not seeing price action, you've got to generally ignore it. So it's something that we look at, we're aware of, we pay attention to, and then we recognize if it is necessary to recognize it. What's going on with the S&P 500? Well, you can see the huge concentration of calls everywhere. And as you'd be aware, if we push through these levels, we keep pushing higher. So basically positive gamma across the board, 53.25, the spot to watch for the Friday close. That could be exactly where the market ends up after non-farm payrolls. But at this point, 5,400 is, of course, what most people will be targeting. Generally, if most people are targeting something, you'd want to stop it just before that level. So if you had a trade, maybe 53.95 or something like that, it'd be worthwhile looking at the tape during that session. What about CTAs? Do they agree? Well, I'd say they're mostly neutral. NASDAQ and S&P CTAs still in the neutral line. Brent CTAs obviously have fallen off, but as you can see, it's delayed data. So we'll find out whether they've actually come back in on this rally or they're continuing to sell. So the next day will be very important for that. And gold CTAs are starting to buy again. So some good signs there for gold. And I noticed while I'm recording this video, gold sent me an alert. So of course that means it's breaking through that resistance level that we discussed about. Let's have a look at some of the hottest stocks. Nvidia now trading at a spot price of $1,224 into, of course, its split. Now, a lot of people are asking, is it going to be a buy the rumor, sell the fact? Well, in this case, I'm not going to sell Nvidia, and I've talked about that many times. The reason is because it is the hottest stock, it is the best stock, and you are basically calling the end of the market rally. So if you're trying to go against Nvidia in any big way, do remember you are trying to call the top, because this is the pillar of this rally. This is the most important stock in the world pretty much for the next year or so, or whatever it's going to be, as it is the driver of everything. And why I say that is because it's like that Intel Cisco play back in the 1990s. They went wild, and I mean absolutely detached from reality. And in a slide I'll bring up in the future, we'll talk about how detached from reality things can really get, because I never put anything past these markets. So the reason why is because if we think about 2021, companies that made no money and were probably never going to make any money were the best things to buy. That was in 2021. It's wild when you think about that. All right, so Nvidia, positive gamma through 1200. As long as it holds above, it's going to start pushing, you think, to 1250. And in general, the markets are pretty positive across the board. It's very difficult to be negative on Nvidia at this stage. What about Tesla? Well, this thing just continues to do the same. 180, 182.50 continues to be the call level. 170 continues to be the put level. And we are coiling inside of this. I think it's going to be an explosive move, as I've said. At the moment, you still got to favor the bulls due to a couple of setups that we've been talking about, but we haven't seen it yet. So what's the only other thing that we've got that really is a cause for concern? Well, it has to do with bonds and options market. We're seeing it rise once again, and this is usually a bit of a warning sign. It actually got back up again, and if it keeps going and the market keeps going bullish and then it gives us a sign of weakness, well, we know what to do. But for now, it's a wait and see. We also see yields dropping back down to 4.7, still trapped within our zone, and that has sent Treasuries back up. Now, Treasuries really will probably start to struggle if yields don't keep dropping, so that's expectation of yield cuts. And we're probably looking at about 94-ish as a possible take profit on these trades recently. Now, I'm not a huge fan of trading Treasuries, but I do think that, as we've mentioned, this level down here was one of our investment position levels, and it's been nice to see it actually get a bit more life, but it's getting close to one of those highs, mostly because of the 2-year and 10-year starting to come back down to heavy support levels. Other leads, things like home construction, held themselves up. Dow Jones Transportation Average held itself up, which is good. And of course, central bank liquidity is always accommodative, yeah? So it is accommodative at this point, and therefore we don't need to worry about that either. What about the US dollar? Well, it keeps failing to get back up to the 20, which is where I'd like to resell it. But as we know, non-farm payrolls is coming on Friday, and that tends to be the mover of currencies. So we find ourselves at an incredible demand zone. Why I say it's incredible is because if this level is broken, I think the US dollar will really start to suffer. And as we've talked about quite a few times, breaking through this point here leads us to believe at this stage the negative kind of information around the dollar is there. I wouldn't really like it to do this. That would actually maybe be bullish on the small time frame. And as I always say, it might be better not to predict this one and to wait for the non-farm payrolls to show us where the flows are going. I do think currencies are going to get wild though over the next week, because central banks are starting to make slightly big changes, Eurozone, etc. And this always impacts and starts to press into the currencies themselves. What about copper? Well, it hit into our 450 level. It's bouncing back up. It's not above the daily 20 moving average and the 470 level just yet, but this may be the end of the copper sell-off. So as you guys know, I'm pretty bullish on copper. I'm just waiting for it to give the signs of strength. Now, one thing that's pseudo shown strength here is gold. So gold's managed to bounce back up and obviously looks kind of white coffee. It's gotten just into this level here and then sold instantly a little bit off the top here. Now, this is a good sign for gold. I will have to unfortunately wait for the next 24 hours because I need to see this thing actually break and close. But that's only because of the way it's done it so far. It could still be a false break with a downside risk. So yeah, we'll wait and see on gold. Obviously, longer term holders like me, we're looking for 3K. So I'd like to see 3K on that thing over the next 6 to 12 months, 18 months, that kind of period. What about silver? Nice bounce. Certainly not enough just yet. 30.85, certainly a level I'm looking for a breakout of. Again, I'd like to see silver and gold both confirm new highs and therefore change arounds. And if you look at the weekly on silver, you'd see this huge rejection week. A lot of you are also going to be screaming at the chart saying, Tom, it's a double top, it's going down. Yeah, I've already analyzed it from that perspective. I'm open to both. I'm waiting for the market to give us the reaction. So we can react to it. And again, one of the most important factors as a trader or investor in terms of success is going to be temperament and patience. And it's the same thing with the UK and US oil. As you can see here, both hit into our key zones for positional-based traders. They might have started to scale in and buy the dip. Still not seeing the signs of full recovery for US and UK oil. It came down like a freight train, so I'm looking for more signs. And it's one that I've got alerts for new lows as well on over the next 24 to 48 hours. Very interested in what happens next on oil. So as we mentioned with Tesla, I asked a few of you guys what you think about the whole Elon stuff. A few of you were pretty opinionated on it, but in general, we've got the price action. I think what I wanted to say there was it doesn't matter what our opinion is of a stock. Generally speaking, if you have no bias, let's say you're completely neutral, you would generally trade that instrument better because you don't really love it. You don't really care about it. So you just look at what the price action is doing. If you ever love something, you're better off to invest into it and not trade it. So this could be considered a left shoulder head and a right shoulder, and therefore, a neckline up here. I think I'm just looking at it more from a coiling basis. If we consider this, we've got 1, 2, 3, 4, 5, 6, 7 days now pretty much trading around the same price. So that means that the longer it does this, the more explosive the action's going to be. Again, at this stage, we know there's a lot of puts sitting at the 170 level. So we have to believe that the buyers are generally committed to Tesla, but it needs to break through 180, 182.50 with the closure. And that hasn't happened yet. But that'll be a very interesting close. So on the close, if that happens, could start a catalyst. Nvidia, well, we got a sign of maybe a little bit overbought the other day, but it doesn't matter. It just keeps going and going and going. And we haven't got any weakness of a blow off or anything like that yet. So into, of course, the stock split. This stock just keeps going. And congratulations for people that are holding one of the three pillars. It's doing very, very nicely. HSI, what's going on here? Chinese tech stocks and Chinese stocks in general, finding a little bit of a rally. I'm waiting for it to get above here to really show that it wants to make market strength. But I think the smaller timeframes already did show it. As I mentioned, our Market Masters Club, free 7-day trial, links in the description down below if you want to come check it out and hang out with us in pre-market opens and posts. Then you can see here that it is trying its best to get above this point, but constantly selling the 18.6 for now. It's making a series of higher lows, and it is trying its best to hold this 18.2 level. Now, some good news coming out for Chinese stocks. I do think that still the AI stocks are heavily underpriced in that market, so we'll see how that ends up playing. Just a bit of an update on the UK market, as we did like what we saw yesterday. It managed to rally. So that's a good sign, and we're looking for it to continue to rally. So I'd like to see the UK market hold up over the next 24 hours. Now on to the US 2000. So this was an interesting one. It bounced off the lows. Now, what I actually did was, I'll switch this to IWM here for a moment, and I'm going to move it over to the footprint because we noticed, and this is something I noticed just before the pre-market, which made me quite bullish on IWM, that we had a lot of positive delta. So even these giant red candles were actually positive delta. Now you can see it's 1, 2, 3, 4. Plus we had the dark pool activity. Plus we had a support. Risk reward was making quite a lot of sense. Now, funnily enough, we end up getting a bit of negative delta with more, looks like a little bit more selling in the top end range here and a little bit more buying in the bottom end range. But I do think that was a positive sign for the Russell 2000, at least for the session. And it's another way you can use these new tools such as the footprint, which if you enjoy it, I'll put it in more videos. So let me know. But yeah, that's something we noticed just before the open. I didn't put it in the YouTube video. I didn't see it, but then I saw it and I went, yep, that's a good one for the session. So let's move over now to the NASDAQ. Well, new all-time highs, obviously not that many stocks really coming with it. More stocks actually finding a little bit of more lows. So is it a really good sign? Well, of course, price action ultimately dictates. It is bullish, it closed on its high, and it suggests there is further market momentum to come and that pullbacks will be met by bull demand. We do need to be careful, and of course, we always need to be alert to the situation around us. But yeah, NASDAQ for now is quite bullish. And what I'm actually doing is I'm using the US 500 again as the catalyst for those types of things. So the US 500 has better levels that we looked at before. Bitcoin, nice, another good day. As we said, this was an excellent session for the close, for the breakup of this particular Bitcoin or crypto. And in this case, we had 1, 2, and we're looking towards 72.5 being broken through. If that does happen, it could start a bit of a flurry. And we all know how a good crypto flurry goes. They tend to buy pretty aggressively, pretty quickly. It's usually fairly illiquid and it runs to the next level. So a nice sign after that coiling. Kind of the type of thing that I'd like to see Tesla do if it actually manages to break either way. For the news, there is quite a lot. So the big stuff here is going to be monetary policy statements coming out from the Eurozone on Thursday. So that's the next session before the market opens. The press conference just before the market opens as well. And then, of course, non-farm payroll change, where they're going to announce 185K, probably new jobs. But really, again, as we know, it's all about the revisions. Check out our previous video if you're interested in knowing more about what's going on with these revisions. I'll put a link here in the description. Basically, that is one of the wildest things in terms of how many they're taking off. If it's your first time here, remember to subscribe, smash that bell icon, guys. And, of course, follow us on some of our other socials as well. Great to have you here. We'll see you in the next one. Good luck out there, everybody. The markets are just getting more and more interesting. Bye for now.